Today we're here to talk about leverage ETFs. Now, leverage ETFs can be a very powerful tool. The problem is not many people fully understand them. Not many people know how they really work, the risk involved, and also the kind of strategies I need to put in place in order to benefit fully from them. So in this video, I'm going to break down what leverage ETFs are, how to find them, how to make sure you don't take unnecessary losses, and most importantly, how to invest with them with the right strategy. So first of all, let's find out what are leveraged ETFs. Now, ETFs are funds that bundle together different assets. So in this case, a leveraged ETF is a type of ETF that bundles together an asset but then amplifies the returns. Now, what do I mean by that? For example, if you have, say, Apple, if you have an Apple stock that goes up by 1%, and you have a leveraged Apple ETF that allows that applies the leverage of, say, 3 times. The Apple stock goes up 1% today, it means that the leverage one goes up 3% today. If the Apple one goes down 3% today, it means that the leverage one goes down 9% because it's a factor of 3. So I hope that makes sense. Now, that sounds all well and good, because just using that example that I just gave, the leverage works upwards but also downwards. So like I said, if it goes up by 1%, it goes up by 3%. But if it goes down by 1%, it also goes down by 3%. So you can lose that money just as fast as you make it. And that's one of the main things that make them so risky. So if you're a person who is willing to take a lot of risk and is willing to actually try to amplify the returns very quickly, you can use these, but you need to understand that there's a fundamental risk there, which means that you can actually lose the money just as quickly as you can gain it. Right, so let's look at some examples, because I'm going to go to my laptop now and I'm going to show you some. So let's have a look at, say, for example, if we look at the S&P 500, we're filming on a weekend, so we can go by what happened on the last trading day, which was on Friday. The S&P 500 ETF VUAG closed on minus 1.63% on the day. Okay, now if you look at the leverage version, so this one is the 3 times S&P, that finished on minus 4.33%. It's not quite three times the fall, but it's approximately. Obviously, they're just trying to mirror it, so it's never going to be perfect. But if you were to invest in just Apple, on Friday you'd have lost 1.63% of the value of your investment. Whereas if you'd invested in the leveraged one, you'd have lost 4.33%, so approximately 3 times. So bearing that in mind, you need to make sure that it's something that you understand, it's something that you're comfortable with, and there's a level of risk that you can take. This is not financial advice. This is just purely educational, just showing examples of different things that you can invest in. Now, before we continue, make sure you like, make sure you subscribe, make sure you click on that notification bell, and share this with everyone. Share. And just a quick shout out to PodEdit, which is the company that I edit all my videos, doing a fantastic job. So quick shout out to them. Check them out. Look them up on social media, so Instagram, TikTok, Facebook, they're everywhere. Give them a shot if you like what you're seeing, and they might be able to do you a fantastic job as well. So without talking too much, let's look at some examples then. So I use the S&P 500 there. That's an index that tracks the 500 biggest companies in America. So if you're very convinced that this index is going to do well, and you're willing to take the risk on, you can actually apply leverage to the S&P, for example. So we looked at a 3 times one. If you simply go on to whichever platform you're using, so in this case I'm using Trading 212 simply because it's the cheapest one and the easiest one that works fine for me. But you can simply type in leverage S&P 500, for example. Okay, and then it'll give you all the different leverages. So Some of them are 3 times, some of them are 5 times. And if you notice, some of them say short, some of them say long. So the long positions mean you're betting for it to go up. So if you're going to buy a long S&P 500 leverage, you're saying that you want the index to go up. If you go for the one that says short, it's called an inverse. You want the opposite to happen. So you're betting that it's going to go down. So that means that if the S&P 500 rises, the short goes down. If the S&P 500 goes up, the long also goes up, whereas it's the reverse that happens. If the S&P 500 goes down, then the short goes up. I hope that makes it clear. So whatever happens to the actual asset itself, the short will do the opposite. If the long goes up by 3%, for example, the short will drop by 3%. If there's leverage applied, so say for example the S&P 500 goes up by 3% on the day, the short that's leveraged by 3 times will go down by 9%. So just another thing to think about. So if we look on the short one for the S&P 500, for example, you can see that's up. That finished 5.72% up, which is approximately 5 times what the S&P long went down by on Friday. So just to make that clear, on Friday the S&P 500 VUAG ETF was down by 1 point something percent, and the S&P 500 short position went up by the same amount. But obviously with this one, because it's got 5 times leverage, it went up by 5 times the amount approximately. It's never going to be exact because it's a tracker. It's only going to do its best to match it as closely as possible, but just getting that. Now the next question is, what are we going to invest in? Now you need to understand that different assets come with different volatility, and volatility means up and down, how much it goes up and how much it goes down. So if you bought a stock like say Apple, like I mentioned earlier, Apple can be quite volatile because it's a very popular stock. People buy lots and lots of it. Or for example, if you want to do something like say the Nasdaq, which is the index that tracks the 100 fastest growing stocks in America, excluding the banking stocks, that's quite a volatile one. So if you have the appetite for that kind of risk, that could be a good one for you. That would give you a lot of upside, but also because the price moves quite a lot, you can also take a lot of downside. So you need to kind of decide on how much risk you're willing to take. Now, if you want to decide on different assets that you might be interested in leveraging, we can now jump into my trusted friend, which is the Just ETF website, and that does a good job of giving you different examples. So as usual, if you go onto the landing page and you just typed in leverage, and then you can click on this little link here. They do a very good job of giving you a number of examples. So they just give you a bit of an example, a bit of an explanation of what they are very briefly, just what we've basically spoken about. And they also give you some maths examples here. So if we use some of these here, you can see what I'm demonstrating. On day one, the S&P 500 ETF, say we started on £100, and the leverage, in this case they're using a 2 times leverage, that's also starting on £100. Say on day 2, that S&P 500 ETF goes down by 5%. Because this is leveraged by a factor of 2, the 2 times leverage one actually goes down by 10%. Now here's the problem. Say for example on day 3, the S&P 500 one now goes up by 5.26%. The leverage one, the 2 times leverage one, will go up by 10.52%. Okay, easy, that's fine. If we look at the second example, the S&P 500 starts on £100 on day 1, and the 2 times leverage starts on £100 also on day 1. On day 2, the S&P 500 goes up by 5%, and because this is a factor of 2, the 2 times leverage one goes up by 10%. So it goes from £100 to 105 in the normal S&P one, and on the leverage one it goes from 100 to 110, 10%. Now, say for example on day 3 it goes down by 4.76%, so it goes back down to £100 in this case. The leverage one will go down to 99.53, so that's 9.52%. So even though the factor is supposed to reflect it, it doesn't reflect that way, and this is called the decay. So having this on a long-term basis will actually have an effect of compounding rather than cumulative. So, and also these ETFs reset on a daily basis. So if you finished on 10% today and then you went back tomorrow, you're going to find on the start of trading on tomorrow it's going to be back to 0. Okay, so you'll find in many cases that the S&P 500 example, the chart on that would be very different from the chart of a leveraged one. So let's see the example again. So if you look on here, if we look on the 1-year chart for the S&P 500 ETF VUAG, and then you compare that with the leveraged version. So if we go by 3 times S&P, so S&P 500. So let's use the pound sterling one. So if you look at that and you look at 1 year, so you'll see that the S&P 500 last year, well, year to date, this time last year, is up by 9.92%. Now you'd expect that the leverage one will be up by 3 times that, but it's only up by 24.53%. So it doesn't exactly mirror it. If you then go even further out, so the higher the leverage, the more there's going to be a difference in the way that it reflects it. So if you look on the 5 times leverage one, so again the S&P 500 ETF finished on 9.92% against this time last year, but if you look at the 5 times leverage one, it's only 3.26% up, and that's down to that decay that I was talking about. So the movements, even though the leverage is meant to be even, they're often not reflected in the way the charts show it because they reset on a daily basis. Okay, so don't think because you're applying a 3 times leverage or 5 times leverage, you're going to automatically get 3 or 5 times the results from the asset that you're tracking. That's not how it works. So we're going to kind of get to the point of actually investing in this. So when you're on the just ETF, you can actually search leverage. Right, so at the bottom that it tells you the best leverage products. This is as of 31st of October 2025. Now bear in mind that past performance has no bearing on future performance. So just because he did well last year doesn't mean he's going to do well. So you got Palantir there, 3 times leverage, Alphabet, which is Google, and you got Alibaba, and you look at those by size, for example. You got Tesla, you got the S&P 500, and you got commodities, and so on and so forth. So it's down to you to figure out what you want to track and what amount of leverage you want to apply. Alternatively, you can go on Trading 212 again, and you can just type in leverage, and then that gives you a list of different assets that you can track. So you got Tesla, you got Nvidia, you got all sorts of different Nasdaq there, Palantir there, Coinbase. So you need to decide on which one you want to track and how much leverage you want to apply. Now, before you do this, Trading 212 or all the different platforms will give you a nice test to make sure that they're comfortable with the knowledge you have, that you have the amount of competence and the understanding of the risk you're taking and the nature of the products that you're investing in before they let you do so. So you basically have to pass a test, and those tests will be in the form of multiple choice questions. Now, if you don't quite meet the required pass grade, they just won't let you do it. If you do, then you can do that. So before you apply any leverage or invest in any leverage products, make sure you understand fully and make sure that you're comfortable with that amount of risk. Now, say for example you want to go with Nvidia, so we'll go with this one for example, and then the principle is quite similar. If you look at the leverage version 3 times Nvidia, in the last year it's down by 14.92%, whereas if you look at Nvidia itself, so if you look on the 1 year performance, that's actually up by 40.47%. And that kind of drives the fundamental point I'm trying to get across. This product is not designed for you to hold. It's not designed for you to sit on it. It is designed as a daily product. So say for example you're happy with Nvidia and you want to invest in the leverage version of it. You search Nvidia, you simply type in Nvidia, and then you see all the different versions there. So you got 3 times Nvidia. You see some of them are in pound sterling, some of them are in euros, some of them are in dollars, and then you also look at the amount of leverage. So these are all 3 times. Some of them say short, so that means you're betting against Nvidia, and some of them say long, that means you're betting that Nvidia will go up. So let's say we want to go for a long one. You'll also see that some of them have different providers, the fund managers. So this one's leverage shares, that's the name of the fund manager, and you got one here that's Granite shares, that's another fund manager, and you got another one called income shares. So the performances will be similar because they're tracking the same index or the same product, the same underlying asset, but you might find slight differences in the quality of the way they track it. So some of them will track it a lot closer than others, but in terms of the performance they should be quite similar. But say for example we're happy with this one, we're going to go with the leverage shares 3 times Nvidia, and that's in pound sterling, which is our local currency. So we don't want to further expose ourselves to the dollar or euro or any other foreign currency, which means that we now have a foreign exchange conversion rate to think about. So we tend to just stick with the one for the country we live in. So in this case, pound sterling. So all you can do then is simply click on buy, and once you click on buy, you'll have 4 options. So you'll have either market, limit, stop, or stop limit. Now, for the sake of this video, we're only going to talk about market and limit. So the current price of the 3 times Nvidia ETF, don't forget that this is not the price of the Nvidia stock itself. It is the ETF that's tracking the performance of Nvidia and then applying the 3 times leverage. So that's currently 4,246 pence. Don't forget, this is not pounds, this is pence. So that means it's 42 pounds and 47 pence. So say for example you want to invest £1 in this. If you use a market order, you just simply click on that little column there and type in 1. Now the market order will execute at the current price, the best available price. So that means that even though that's showing 4,247 pence, if you put that into the market order, the system will go trying to find the price as closely matched to that as possible. That doesn't mean you'll exactly get that price shown on screen. It just means that it might be a little bit higher, it might be around about the same, but the system will try to get your price as closely matched to that as possible. So once you click on that, you click on review, and then it gives you a summary there, and it tells you the order type is market buy, the share value is £1, that's how much you're investing, and because Trading 212 allows you to invest in fractional shares, it will just give you the amount of shares that your £1 can buy, and in this case it's 0.023 shares. And because it's Trading 212, it's commission free. Now some platforms will have some commission applied to it, so make sure you look into that as much as possible. You want to keep those fees and commission as low as possible. If you can find a platform that gives you free commission, even better. And then it gives you the total there, and all you have to do is just to send the buy order. Now we're recording on a weekend, so that will execute when the market reopens in 1 day, 9 hours and 51 minutes time. And all you have to do then is click OK, and it's now sent in the buy order. That means that when the market reopens, the system will go in trying to find a stock on sale for close to the screen price as possible. If it doesn't, then you keep trying a bit higher until it matches something. Now, say for example you want to mitigate that, so that price could easily go up to say 5,000 pence by Monday, and the system will purchase those stocks at that price on Monday. If you want to avoid that, you can use what's known as a limit buy, and with the limit buy, you'll tell the system the maximum price you want to pay. If you click on buy, click on limit, you can use the slider to say £1 and 2 pence, let's say, and now you can tell it, I don't want to pay any more than say 4,300 pence. That's the maximum I'm willing to pay. Okay, you click on review, and then it gives you summary. So what this is now going to do is to find a stock or shares of that asset, but anything beyond the price limit you set, it will not execute. It will only find something either on that price set or below. Now, if the price shoots up and it's say 5,000 pence, it simply won't execute. Now, that's good in a way because you're not overpaying beyond what you are comfortable paying, but it can be a negative because if you were to execute a market order and you buy 5,000 pence and then that stock continues to rise to say 10,000, you can participate and benefit from that increase in price. Now, in this case, if it doesn't execute and you don't buy the stock because you're waiting for that price to come back down, if it never hits, you've missed out on that growth on the stock price. So just something to bear in mind. But looking at the summary here, it gives you the order type limit, numbers of shares, tells you 0.024, so that's the fractional shares again. It tells you how much that's worth, the limit price that you set, the expiration, because it's on a weekend, it's on never. If it was on a trading day, it'll give you the option of end of day, so it means that you keep trying to execute that trade until the market closes on the day. Again, commission is free and it gives you the total, so you can just send your order there, and it tells you again, because the market is short, once the market reopens, you'll execute that, and you just click on OK, and that's it. So now all you have to do is just to go about your business, do what you're doing, and then once the system has managed to execute those trades, you get a notification, and then you'll be a proud investor in the stock. So we've covered a few things here, so just a quick summary. First of all, we've talked about what leveraged ETFs are. We've talked about how they work. We've talked about the risk that they carry. We talked about the potential risk in keeping them longer than they're intended. They're designed as daily products, so they're not designed for you to hold them long term. We've also talked about how to actually find different options, so different assets that can be tracked. We talked about the difference between going long or going short, and also I've shown you how to actually invest in them. So I hope that helps somebody. If you have any questions, if you have any queries, leave them in the section below. Make sure you like, subscribe, make sure you send this to somebody. Now, make sure, I actually thought about not making this video because I understand the risk involved, but I think there might be people in there that might be interested in this kind of product, and that's for them to decide. It's up to you to do what you want for your money and whatever risk appetite you have. This is probably one of the highest levels of risk you can take with your investment. If you're comfortable with that, then that's up to you. It's not financial advice. Make sure you don't take it as that. But I'm going to be covering more different strategies, so make sure you join me. Leave your comments below. It's Roadman Investor.